There is no doubt that construction and housing is absolutely key to growth in this economy. It always has been. We've got a problem in that construction prices are still high due to inflation, and there's very little the Chancellor can do about that. But she could reduce stamp duty. It would stimulate demand and you would get housing transactions up, which then has a trickle-down effect across the whole economy. I think, activity breeds tax take. So by offering certain tax breaks that are politically acceptable, you can generate more tax for the Treasury. And stamp duty, as I said, is one of those. The construction industry's got some major challenges at the moment. The sales values aren't supporting the cost of capital and also the cost of construction. We've got another problem, is the average age of a construction worker in this country is way too high. So it's not just we can't get goods cheap enough, we can't get labour cheap enough, we can't get skilled labour cheap enough. So we need to have a think about the education process and all the opportunities that are arising from 3D printing, from AI, and try and think harder about apprenticeships, taking people out of school once they've finished who can't get jobs. Instead of going to university, work out how they can best be trained at the most cost-effective way to enable the construction industry in the UK to be unlocked and be competitive. So we're not always looking to migration to bring cheap labour into the country. We need to think about the fact that we've turned students away, or we're making it less appealing. And one of the greatest exports that we've got other than financial services is education. And it's absolutely key that we continue to make it attractive for foreign students to come and live in London. And I also think that education is key. So we need to think about how to properly finance that, how to make us the place, as we have been on and off over the years, to study and make sure that the UK retains that global appeal as a place where you can come and study and learn. The government's net zero policy, like the rest of the world, is problematic. We make up, I think, just under 1% of the world's emissions. So there's two arguments, right? The one argument is that if what we're doing isn't really having an impact, then why are we spending money doing it, and why are we making ourselves poorer in the process? The flip side to that is, if we do nothing and say, well, China's going to be emitting, so we might as well emit too, otherwise we're going to pay on a comparative basis, then you kind of give up. And I'm of the school of thought that Britain's always been at the forefront of change, and I still think that there's technologies and there are solutions out there that if we can crack it, other people will follow. So I think the government's net zero policy, as blanket policy, needs to be thought through. How do we stimulate the actual technological advances that can be both effective from a climate change perspective and not detrimental to us from an economic perspective? Because I refuse to accept that there's nothing that goes hand in hand. The UK needs to be a leader in that, not a follower. One of the things that's pleasing me early in 2025 and hopefully through next year is there seems to be a consensus that people should work in offices again, which is great. Every economy needs people working together via osmosis, learning together, sharing information and knowledge, and then using their lunch hour to buy things and trickle down economics and make sure that the guy who repairs shoes or sells newspapers or whatever it might be outside offices has also got some money in his pocket, and he's distributing that. So I think the end of the working from home phenomenon is in sight. Flexible working is going to be here for a very long time, but I think that is rebalancing in a really positive way, and I'm really keen for that to continue. And I think that there's a requirement also to use the built environment, office space, and maybe have some crossover with education. What we don't see is, a friend of mine is running a program where students are coming into offices to learn rather than sitting in libraries, and using that environment to talk to to company owners, to CEOs, potentially get some work experience. So I think that, I'm looking forward to the built environment starting to be a place you want to go again. Go back to work, go out with your mates after work. I think that people sitting at home behind laptops is just a disaster for them, for their mental health, for the economy, and for society as a whole. And it just feels like the kind of all of that post-COVID hangover is starting to finally work its way through the system, and we're back to some kind of more interactive, in real life environment. I'm looking forward to capital starting to see a bit more confidence in the UK, in the construction sector, particularly this government's got a lot of work to repair some of its early false starts. It'll be very interesting to see how the global landscape changes now with America putting more pressure on Europe to fund itself, to come up with its own defence budgets, and what that means for UK companies, what that means for their real estate needs and requirements, and also what that means, for stock markets, the city, financial services. It feels like there's been a lot of change in the last 12 to 18 months and very little clarity, and that's further created that lack of clarity by Trump's recent election. So I think the longer we get into his term and into this government's term, the more clarity we'll see on where the world's going, and it will be advantageous to have that, easier to invest, easier to know where to deploy cash. And it'd be good to see some liquidity back in real estate markets. There's been a definite dearth of liquidity because rates have just been too high to make the numbers work, and so have construction costs. So hopefully the rebalancing will continue in the next 6 months, and 2026 are interesting times for us as the lender. I think in 2025, with interest rates starting to come down, what we do will start to look very appealing from a risk-reward perspective again. Investors are saying to me, I need to get my money to work harder for me. I want to see return on my cash, preferably quarterly. That's not to say they won't invest in rolled-up transactions, but they want the risk-adjusted returns to be right. Investors like myself are more focused on location than ever before. We're seeing property go back to its fundamentals. People aren't buying assets just because they can get a positive cash flow, because it's harder to generate the kind of paid returns than you could when interest rates were zero. So investors are very keen to understand the location, the fabric of the assets that they're investing in, the business plan. And if all the boxes get ticked, then I think there's a lot of demand. In our particular loan book, we've seen some redemptions, but we've also seen some strong pent-up investor demand to reinvest when they've had their capital back. So there's no doubt in my mind that investors still really like the sector. They like what we do. They're probably more risk off than they were in 2020 because they've just been through a change in cycle. But I think that's natural, and we can underwrite the right transactions to suit. And overall, I think there's appetite. There's appetite, there's positivity. I'd say there's cautious optimism from investors to continue to invest with us. There's a little bit more negativity around the UK in general, but that's to be expected. And we just got to make sure that we're always on unearthing those outliers where we can manage risk and get really interesting returns. And I think we can do that because we're not a fund, we're not deploying huge amounts of capital that we have to get to work. We can be very selective, and where the stars align to make a really interesting loan, we can move really quickly to deploy cash. Borrowers are still finding the market very tough, especially if they're sitting on land, they're developers, they're trying to get through the Building Safety Act, they're trying to bring projects to life with so many hurdles. It feels like if you're a borrower and you've got a difficult, complicated scheme or piece of land, life doesn't get easier. Rates are still relatively high, even though they're coming down. Costs are still high. Building Safety Act's a problem. And borrowers are still feeling a little bit jaundiced and kind of are wondering when the market's going to come back and have that kind of exciting edge to it that we haven't seen for a while. But at the same time, the kind of borrowers that we lend to have been through cycles before. They're nimble. They're ready for when the right opportunity arises. And a lot of them still have meaningful equity to invest as and when they feel comfortable. So borrowers are tired, I think is a fair description. They've been slogging away, protecting their equity, working hard, but they remain opportunistic. And, it all goes back to interest rates, government policy. Those are the two things that will really stimulate demand. Interest rates keep coming down. The government create a bit of excitement, whether it's by reducing stamp duty or some kind of version of a Help to Buy scheme, something that gets the developers off the fence and say, this is good, we can make some money here. That's what we need.